Hey there and welcome back. In my past several videos, I've really been focusing on talking about Chinese stocks and how the latest developments from policymakers have had on the Chinese market. But no discussion on Chinese equities is complete without talking about the two heavyweight tech giants in China, and that's Alibaba and Tencent. These two companies are the crown jewels of China's technological revolution, yet they are both down more than 40% from their highs, and their valuation is trading at multi-year lows. Today we're talking about whether Alibaba and Tencent have created an attractive entry point for new investors or for existing investors to add onto their positions. And to do so, and to make sure that everyone's on the same page, I'm going to do an overview of their latest business models. Then I'm going to discuss the political landscape that they're grappling with, why they're trading at multi-year lows in the first place, and finally offer my thoughts on where I believe the stocks could go in the foreseeable future. The reason I'm going to talk about them together is that in today's market environment, I believe that they are both very tightly correlated. Along the way, I'm also going to offer my opinion from a financial analyst perspective and also from a political observer perspective. I'm going to give you a very detailed understanding of the system so that you don't just immediately think that these companies are undervalued or that this sell-off is purely unjustified. If you're new to my channel, my name is Larry Chung, CFA. And on my channel, you'll find me talking about deep insights on the companies and industries that I'm personally investing in. And if you like what you see, consider subscribing, turning on that notification bell, and hitting that like button to let me know that you agree with what I have to say. Okay, let's start from the beginning and go over their business models so that we understand why so many institutional investors and retail investors like these companies and their stocks. Alibaba is the largest e-commerce operation in China, where the primary way they make money is through their core commerce websites, followed by cloud computing and other initiatives. Tencent, on the other hand, is a diversified tech giant that makes its money through its value-added services segment, which includes gaming and its social networking services. Tencent also plays in the fintech sector with WeChat Pay and cloud services. Finally, Tencent also has an advertising business since they own social platforms with a large user base. Between the two companies, they command nearly market-leading status in the industries they compete in, and they routinely grow their revenues, operating margins, and profits year after year. In fact, in Alibaba's latest earnings report showed us that they generated $31.8 billion in revenue and around $7 billion in net income. And although Tencent has not reported their earnings yet, it's slated to be released later this month, their last quarter produced growth on essentially almost all parts of their business. Yet, both of these companies' stocks and valuations are trading at multi-year lows. And by some estimates, Alibaba trades at 16 times forward earnings, while Amazon trades at 50 times earnings. In other words, Amazon's valuation is nearly 3 times as high as Alibaba's, even though their growth rates are similar. Now, of course, there's a good reason for this, and I'll cover why the discount rate needs to be higher for Alibaba. But for comparison, from a traditional valuation perspective, Alibaba is undervalued compared to similar companies. Despite this undervaluation, though, Alibaba is down nearly 20 to 25% this year, while Tencent is down more than 30%. And this is even after Alibaba initiated record buybacks of its stock after its latest quarterly earnings. Now let's talk about the real reason why investors were caught off guard and why all the bullish analyst commentary on Alibaba needs to be balanced with the risks of the current landscape. And to do so, we have to understand the most likely reason that Alibaba's share price peaked in late 2020. So in late 2020, you'll see on this chart that Alibaba, along with other major Chinese stocks, peaked around the same time frame. And one major catalyst that many analysts haven't discussed enough is that that was exactly when Jack Ma's Ant IPO got pulled from the market. This event is so significant that I want to spend some time helping you understand the situation. This event will help us notice future situations that might cause pivotal moments for the company's share price. It also helps us understand the beginning of the crackdown of Chinese tech companies and will help us understand when sentiment might start to change for the better in the future. So buckle up and let's revisit what happened in late 2020. Now, in late 2020, when China's President Xi stopped Ant Group's IPO, he and the CCP, the Chinese Communist Party, were worried that Ant Financial was adding risk to the financial system, along with being upset with Jack Ma over his controversial speech and commentary about China's policy to strengthen financial oversight. Another reason for stopping the IPO was that Chinese officials grew increasingly uncomfortable with Ant Financial's highly complex ownership structure and the people who would gain upon the IPO being successful. In Ant's IPO perspective, it wasn't clear who were the firm's real owners and shareholders, and it was later discovered that the owners of Ant IPO's listing shares were well-connected Chinese individuals who have connections to political families that represent special interest groups that vary from President Xi and his inner circle. Had the Ant IPO been successful, those individuals, along with Jack Ma, would have greatly enriched themselves even further and would have made Alibaba even more powerful and difficult to regulate. Even more serious was the fact that Ant Financial made loans to 500 million people and operated the country's largest money market fund while selling other financial products. However, it didn't follow the tough regulations and capital requirements that traditional commercial banks have to. And so while Ant Financial makes profit from its transactions, the state-owned banks that supply the funding actually took on all the risk. By stopping the Ant IPO, President Xi hoped to make the financial system in China more stable and discourage the massive types of payday and accumulation of wealth that the CCP is frowning upon recently. To put it simple, Ant Financial was putting a lot of financial risk onto China's financial system, while the owners of this business were having big paydays. Now, where the seeds of a worsening relationship between Jack Ma, Alibaba, and China happened was back in late 2020 when Jack Ma harshly criticized regulators for rules he said were unnecessary and held back technological innovation. This speech upset many of China's top financial officials who were in the same room as the speech. By publicly criticizing the CCP's regulatory powers, along with the issues from Ant Financial's ownership structure, CCP decided to decisively shut down the Ant IPO. And not only that, the company had to scale back lending along with bank-like services. Given that Alibaba owns 32% of Ant Financial, this development was a major source of headwinds for one of Alibaba's growth prospects. This catalyst alone was estimated to shave off about 60 billion of future market cap for Alibaba, and that alone is around 10% of Alibaba's current market capitalization of more than 500 billion. To provide even more detail into the ownership structure of Ant Financial, I recently dug into a very important article from the Wall Street Journal that detailed the corporate structure behind the investors in the Ant IPO. One of the largest shareholders in Ant is a private equity firm called Boyu Capital. And this company was founded by Jiang Qi-cheng, who is the grandson of the former Chinese leader Jiang Zemin, who led China as general secretary from 1989 to 2002. Most of Mr. Jiang's allies were purged in Mr. Xi's anti-corruption campaign, but Mr. Jiang still remains a very powerful force behind the scenes. Another powerful stakeholder in Ant Financial was controlled by a group known as the Shanghai Faction, which is led by the son-in-law Jia Qinglin, a former member of the Politburo Standing Committee, which is the top echelon of China's Communist Party. Back in 2012, Jiang Qijing, also known as Alvin, helped Jack Ma negotiate a deal to buy out half of Yahoo's stake in Alibaba. Jiang and his political connections helped Jack Ma provide the financing needed to get the deal done. In China, the children of the elite, with all of their political connections and business connections, are known as princelings. And President Xi has very little interest in helping them continue to enrich themselves while furthering the inequality gap. Another very important stakeholder in the Ant IPO is Li Botan, who controls the investment firm called Beijing Jiaode Investment Group. Mr. Li is best known for establishing the infamous Mao Tai Club in China, which is a private club in Beijing's Forbidden City that has had a very popular place for princelings and their guests. Now, since President Xi took power in 2012, he's expressed his strong displeasure with the lavish events and the many mistresses brought to these events. To President Xi, these events highlight the pinnacle of corruption from wealth and power, and events at the Mao Tai Club are often discussed by Chinese netizens as examples of corruption of the princelings in China. Had the Ant IPO been successful, these same people would have been greatly enriched further and become even more powerful in China. This would weaken China's image on its ability to reduce inequality, which is one of their biggest goals in the future. All of this news and developments demonstrates that there were two pivotal events in late 2020 that sparked a crackdown on all of Chinese tech that would later determine Alibaba's future trajectory that continues on to today. A simple check of technical analysis would reveal that Alibaba peaked in October 2020 when the Ant IPO was shelved. This was a confirmation that Jack Ma's controversial speech from late 2020 of criticizing financial regulators continues to put pressure on the company's share price even until today. This kind of pressure will continue to stay on until relationships are improved between Jack Ma, Alibaba, and the Chinese government. I think Alibaba paying the record fine is just the first step in improving relationships in China. This also demonstrates that while Alibaba will continue delivering revenue growth, EPS growth, even margin expansion, the company stock has continued to be suppressed because it is under the mercy of policy direction. In fact, another way the CCP is starting to rein in on Alibaba even further is in their latest quarterly earnings, it was discussed that the favorable tax treatment that Alibaba receives today, because it is a key software enterprise, it's called KSE, it enjoys a preferential 10% tax rate that other internet companies in the Chinese market also enjoy. However, these tax rates are expected to go up in the September quarter because Alibaba's management stated that Chinese officials may be removing the status of key software enterprises for Alibaba. And for comparison, the standard corporate tax rate in China is 25%. Up until this point, Alibaba has qualified to pay the 10% preferential tax rate. Now, this is very important because the CCP can continue to introduce additional measures that discourage anti-monopolistic behavior. And if any behavior is found that is monopolistic, it's possible that Alibaba could be broken up. And investors are putting a very high discount rate on Alibaba as a result. So the fact that the stock price has fallen 40% from the highs is not totally unjustified. Meanwhile, Tencent's leader Pony Ma has been much more low profile, and despite not stirring up controversy, Tencent has also been under regulators' crosshairs after regulators identified gaming as initially spiritual opium. Now that phrase, opium, is extremely important because it's a reference to the Opium Wars of the mid-1800s. And this history of the Opium Wars continues to influence in part of how China's political leaders think of their Western counterparts. Opium was a drug that was exported to China and was largely blamed for weakening the Chinese population and serves as a very serious taboo image in China. After losing the Opium War, it was during this period of time that Hong Kong was ceded to Great Britain. Now, in all of their new policies, the CCP not only wants to boost its birth rate, but also ensure that future generations and youth has allocated a lot of their time in productive studying and preparing to be future leaders in modern China. High-level policy officials most likely frown upon the social structure of Chinese youth spending so much of their time on gaming, which can impact adolescent attitudes and derail them from spending the time necessary to improve in their academics, their social skills, and also their professional prospects. However, regulators later retracted this phrase from describing Tencent's mobile gaming business as spiritual opium and softened the language, and therefore Tencent's stock later rebounded. Tencent has been very swift with their responses to regulators by saying that they will crack down on their gaming policies by introducing more curbs. In my opinion, the two tech titans serve as the innovation powerhouse in China, as the country relies on these companies to fuel its technological prominence. But with that said, I believe that both of these companies need to develop collaborative relationships with the Chinese government in order to continue their previous history of growth. Tencent stock and Alibaba stock have both been severely affected by the Chinese government's new crackdown on any industry that isn't serving society in a way that the government sees fit. Now, while both of these stocks are attractive from a fundamental perspective and valuation perspective, I do believe that Tencent has had fewer issues with regulators, as I haven't seen any controversy between company leadership, Pony Ma, and Chinese officials. On the other hand, Jack Ma has still had to lay low and be very low profile because the CCP has shown great distaste for his public remarks on the country's financial affairs. These companies definitely do deserve a spot in your portfolio if you have a long enough time frame, but they won't be out of the woods completely until there is indication that regulators are more supportive of their business initiatives. The investment company Temasek, which manages the Singapore Sovereign Wealth Fund, holds China at 27% of its portfolio as of March 31st, 2021. However, it is a sovereign wealth fund, meaning they take an ultra long time frame when investing. They, for example, with that long time frame, would make it more suitable to invest in China. Now, from a valuation and financial analyst perspective and a discounted cash flow analysis, both Alibaba and Tencent are worth probably at least 30 to 40% more than the prices today, according to Wall Street models. But with the political environment currently in place, it's important to know that those valuations will not likely be achieved in the near term. And it's important to have a longer term view on these companies as regulations play itself out. Ultimately, they will continue to be the market leaders in China. The difference between where the stock is trading now and where it should be trading is going to be your time frame. I've personally used this market environment to make Chinese equities nearly 1/3 of all the investments I own. And in this market, we have the option to choose between a very expensive S&P 500 or NASDAQ and a highly regulated fast-growing Chinese market. I believe that it's important to invest in both the US and China. The risks are clearly higher for investing in China, but so are the rewards. So let me know what you're doing with your investing strategy in the comments below. And as always, subscribe and turn on that notification bell so that as soon as I have a new video, I will see you there. Cheers.